Good evening, friends. We would now start our uh, webinar on your queries, on your stock queries. Today we'll take a different tact a bit. We'll start from with small presentation because this has been very volatile times. So I would go through a presentation. During the presentation, I might not be able to see your questions, so just write your questions in the chat window. One of my colleague, Ms. Rupsi, she would take care of those questions later on if you have them. So let's go through the short presentation. Largely, I will try to cover our viewpoint on few of the things. So let's take the first thing. One is a macroeconomy. But now one of the big developments that has happened, as you all know, has been that a new governor, Dr. Raghuram Rajan, has taken over as RBI governor. Now, based on what readings and of his papers that I have done over last few months, especially his book Fault Lines and many of the publications, papers that he has put on reputed economic journals. There are few key things that I think Raghuram Rajan will start focusing on. One would primarily would be the currency. As you know, unlike China, India does not follow the pegging method, as in RBI does not tries to actively interfere in the currency market such that the rupee would maintain certain kind of level. Largely, this thinking has come because of the balance of payment crisis that India had seen in 1991, when in pursuit of protecting the rupee value, RBI had to end up spending lots of foreign exchange, and which had resulted in a balance of payment crisis later on. And we had to put our gold for mortgage in order to get loan from IMF. So since then, RBI has started to actively just monitor that the volatility of the currency is less, but it does not tries to put any value to the currency as such, and it allows market to take that determine what the value would be. So his first criteria, I think, would be to make certain that the volatility in the rupee has come down. There is more predictability to how the rupee moves, but I don't think he would be aiming for certain value of rupee as such. The next thing, as I've written on my presentation, would be the inflation. In the last monetary policy review that Dr. Subbarao had done, the RBI had clearly mentioned that they would see to it that the consumer price inflation is at 5% by March 2014. In the press conference, as well as the his speech post his and he become Raghuram Rajan becoming the governor, he had alluded that he would continue to maintain that as a target also, meaning inflation control of with target say the target of inflation, that is consumer price inflation, which today is around 9.6%, at 5% by March 2014 would continue to to remain one of his primary targets. Significantly, we believe that both of these two reasons should result in a short-term interest rate hikes. In this, by short term, I mean that over uh, next course of the remaining financial year, we should see another 100 basis point to 150 basis point increase in interest rate, both to boost currency as well as to boost as well as to decrease the impact of inflation in the economy. Once he has achieved that, I think only then the governance and outlook would change more towards a growth focus. Raghuram Rajan, in most of his paper, has presented that the primary objective of any central bank is to ensure that the inflation remains at a low sustainable levels, and he comes from a school of thought that believes that a low inflation level is not necessarily a contradiction with respect to growth. He believes that over long term, maintaining a low inflation level itself becomes seeds for a high sustainable growth levels. So I think inflation and currency would be his primary task, and because of which we should be open to the fact that there may be some interest rate spike. One significant thing is that he has postponed his macroeconomic review, which was scheduled on 18th of September to 20th. This is largely because he would like to see how US Fed, which also has its policy meet on 18th of September, would give indication to the market as far as the tapering is concerned. To go back a bit, what US Fed had done was that in the past they had started with quantitative easing policy. Because of this quantitative easing policy, a huge amount of liquidity was put into the global markets, and we had seen since over last 3 years, equity markets rally a lot, largely driven by this quantitative easing. Now because there are noise, to say, if I can use the right word, there is a noise within the federal board itself, that now that the growth rate of US is becoming much more discernible, there are much more evidences that that growth rate can be sustained, there is a case for withdrawal of that quantitative easing. But this withdrawal would not happen immediately, they would go in a phased way. So as of now, they are buying at the rate of 85 billion. They are pumping at the rate of $85 billion every month. They speculation is that they would decrease that rate initially, and only sometime later, let's say in 2014 end or 2015 March, they would start trying to close that buying part. Uh, to put to you my views, I generally don't think tapering as such is a very big event. The large reason being because of two things that I have been seeing in the US economy. One is the in the US economy, I have seen that many large banks are sitting on cash. There is little kind of evidence for saying that there is a credit growth that is happening. Uh, Rather, US is running a good risk of seeing a deflation like we have seen in Japan over last 20 years. And if that happens, I think there is a good case for saying if US Fed will continue with this uh, policy of quantitative easing for some more time. More important than tapering as such, even if the tapering would were to happen, let's say, I would be more interested in seeing till what time is US Fed and are going to keep this low level of interest rate going ahead. As of now, they have said that they would like to keep this interest rate low at least till 2015. Now, as you all know, interest rate is one of the most dominant factor that goes into how any financial asset is valued. If the interest rates are high, typically the valuation of each and those financial asset products would be low. If the interest rates are low, typically the valuation would be high. So in looking at interest rate in US would be a major factor for us going forward. Okay. uh, as far as growth is concerned, uh, as RBI has been saying for last 2 years now, that primarily India is facing a supply side inflation. What we need is more support from the government, as in more reforms, like reforms in the type of a much more better land acquisition bill than what has come in the parliament, better labor policy, a much more clear cut environmental policy, a much more better manufacturing policy that allows India to rapidly put manufacturing in place. To give you an example of why I think this is important is any country should actually not worry much if its currency is uh, depreciating, especially a country like India, wherein at least the government does not has too much of foreign exposure, foreign exchange exposure. It does not has too much of foreign borrowings. Uh, because what happens is, if let's say the currency which was at 50, it has come down to let's say 70, all of my goods that I was exporting have now become at least 40% cheaper for me, and so naturally the demand for my goods should increase. Corollary, what also should happen is multinational companies should start looking at India as a much more better manufacturing base than any other country in the nearby geography. But unfortunately, a very uh, because of the large amount of red tapeism that has now started creeping back into the bureaucracy, we are seeing that in the Indian government is not that as nimble, and the Indian economy is not that as nimble in allowing new manufacturing to come in. So if I were to take a case in point, think of it like a company like LG. LG is selling TVs, let's say hypothetically in India, but they are buying it from Korea and they are selling it in India. Now, if they were to start and instead of buying from Korea and selling it in India, if they were to start a manufacturing base in India, automatically if he would see that Indian manufacturing should be at 40% cheaper, Indian labor should be 40% cheaper than what it was in the past, and this should allow him to earn much more better margins if he were to export from India as such. But unfortunately, we do not have a very good manufacturing policy, and that does not take in place. So I think growth is much more a government determined thing rather than RBI looking at it. Even if RBI tends to decrease the interest rate, it might not play out. Let's move to the second thing. There is one query that has been coming from some of my subscribers. One is largely why has our buy signals largely coming from metals and banking space. So I'll put those thinking in place. Broadly speaking, the reason why we have been more bullish on metals and banking to us and if I were to say recently we are now becoming again a bit more bullish toward capital goods is because the valuations that we see in this space are at such a dirt cheap level. To use the words that Rakesh Junjunwala used, these are available at chori ka mal type valuations. Now, what I mean by this is across the board, and probably in some of the companies, I would show how I'm looking at it. Uh, Across the board at some of the company, in many of the companies we are seeing a historically low valuation levels. These are the valuation levels that was reached in some of the cases in 2001 2001 and market crash levels, and post that uh, these companies had done phenomenally well, even though the market had not done well. So for, if I were to take example of, let's say, BHEL, now at the price of 103 101 that it had reached about in let's say 2 weeks back, now these valuation level of 103 was the level that BHL had reached also in 2000 and 2001 and a market crash because of the IT and a bubble burst. Now, and I'm not looking at just 10-year history, I'm looking at the whole of his HL since the time. So these are so low valuation levels, and to tell you what happened last time was that even though the market had not recovered much over the next 1 year, so that is from 2001 to 2002, BHL had ended up giving 100% returns, even though there was substantially just marginal change in the company performance also. The reason that I'm trying to tell you this story is that at times the valuations can get so beaten down that becomes commonsensical to say that how low it can go, and if it goes below more this than if it's a promoter driven company, they should either delist it. If it's a government driven company, they should abolish a policy of disinvestment, rather make it 100% government owned, strip the asset of the company, and probably that may be a better way of solving government fiscal deficit problem than looking for disinvestment as such, because many of these PSU are sitting on huge amount of cash. Many of these PSUs also are sitting on very good asset base, and they are beaten down to a level that it makes commonsensical to now invest into these companies. Would companies go down below the price that we may recommend? Probably yes, in the short term it is possible, because as I have been telling you, there are lots of risk in the market, and many of the people are not yet factoring those risks. So yes, I do believe that another 10% correction can happen in the market, and because of that correction, yes, even many of the stocks will also react, but I would use that as a buying opportunity, and I would start to create my portfolio for the next 5 years, because these are the companies that would end up becoming giving me substantially huge returns to my portfolio, unlike investing into FMCG as of now. So within the metals, however, we have to be cautious. It's not that each and every metal company can be bought. And let's say look into why. The type of companies that we typically like within the metals have certain broad characteristics. One, they have very low leverage. They do not have, ideally, they do not have debt. They're sitting on very huge cash position, which they can deploy if they want in pursuit of growth, or if they want, they can now buy in a good international assets at very low prices. They also have very low cost asset base, meaning what, that even if the prices of their metals or their ores were to fall down, the cost of operation of these companies are so low that they enjoy phenomenal margins. So if you were to look at NMDC, typical margins have been in at least 30 to an 60, 65 percentage. The worst case has been a 30 percentage margin. So these are the kind of assets that in a company, some of these metal companies are sitting on. So we tend to like these kind of companies. We believe both of these points result in a company having a very strong moat that protects this company from a very severe downturn like we are seeing as of now. Can the prices go down? Yes, the prices can go down because markets tend to be irrational. They on both the sides during when things are becoming too negative as well as when things are becoming too positive. To give you a point of NMDC itself, NMDC when it in Jan of 2001 was giving a dividend yield of 20 percentage. It was not just for a day or so, it was giving it for a whole of the month. A whole of the month, investor had an opportunity to buy into NMDC with a dividend yield of 20 percentage. And whole of the year after January, they had an opportunity to still buy NMDC at a dividend yield of 10 percentage. And people were not ready to give it a price to book value of even 0.2 per 2, and at the peak people were giving it a price to book value of 20. Both of these are irrational extremes and we should take benefit of this volatility. That is why we like companies which have low leverage, low cost asset base. We believe this creates a moat. This creates a very sustainable business model. Can the prices go down below? Yes, it can, because market tends to be irrational, but this irrationality of the market I would like to encash on and try and build my portfolio around it. What I would like to avoid within metals companies, as I've said, I like low leverage companies, so it's not surprise that I do not tend to like companies which have very high leverage. Some of the companies, these are well-known names like Hindalco and Tata Steel, but they are having huge leverage. And in a scenario wherein I am seeing that there is more probability of interest rate increasing, this high leverage tends to make me scary. It tends to make me scared because I don't know how things would play out. Whether they can become multi-baggers, yes, they can definitely become multi-baggers, but they tend to come with a very huge risk that they may end up resulting in a very large losses to my portfolio without any recovery in possibility. That is why I tend to like a high leverage and a metals company. Now the similar reasoning is I tend to do not like companies which have very low margins in the metal business. The reason is because even a small correction in the metal price uh, would result in losses to these companies. And in case of these scenarios wherein we do not know how long a slow growth and a global environment can play out, a low margin business need not be a very viable investment strategy for us. So we are explicitly saying avoid these two type of companies: high leverage and high cost asset companies, because these would be exposed to a double whammy. They will not just get hit because of the leverage, but even the small difference in the uh, revenue pricing that they are charging may result in large substantial losses to the company, and because of which the prices may react very badly. In the banks, there is one thing that we need to get adjusted to, and I think many players in the market are not getting adjusted to. uh, while yeah, you can definitely say that I may have bias towards it, but I'm seeing lots of evidences towards it. So I have to tell you that we are substantially in a different set of environment, economic environment to speak of, than we were in about uh, from 2000 to 2010, probably a bit more early. 1995 to 2012 was a phenomenal year wherein most of the countries had grown at least about 5.5 to 6%. The world GDP growth was one of the one very big thing. It has been phenomenally high growth rate period. It was not surprising, therefore, that lots of people who have been raised beyond poverty. They are now effectively the middle class of the emerging economy. But we need to be cautious because the world economy always moves through a cycle. Now we are entering in a cycle which would be a much more slow growth cycle. It would be low volatility, so the growth would not tend to fluctuate much. It would be low volatility, but it will definitely be a slow growth environment. Why am I saying this? Because I'm looking at places not just in India, but many places like US, Europe, uh, in some cases like even cases like China and Australia, where most of the people, both retail people as well as companies, are coming to the conclusion that having debt is too risky. Having financing debt is too risky, because even a small change can result in a large NPS with the bank. Another thing is that because of this, most people are trying to deleverage their own balance sheet, and because of all this, banks not giving out debt, people not seeking out debt, a credit-led growth, a leveraged credit-led growth that was happening in the economy over last 15 years might not happen with the same rate as it had happened in the last 15 years. And because of this, we may see a much more slower growth. It would be a much more sustainable growth, but it would be a much more slower growth. It is not necessarily a bad thing. What it typically means is, in the high growth period, any company which does even reasonably well tends to create outperform even the uh, no, even the average company. But in a slow growth environment, only companies which have real moats, only companies which have real innovative businesses can tend to outperform the market. And that is why slow growth environment does not necessarily mean it's bad for the economy. What it just means is that we need to restructure our portfolio towards companies who have real business moats. And once we do that, I think our portfolio can actually outperform most of the market. Uh, there in when the economy transits from a high growth period to slow growth period, typically many of the assets, many of the projects that were economically viable in uh, based on the high growth economic environment might not be economically viable going forward. So this may put a huge pressure on the balance sheets of the banks, and this may result in some of the assets that actually should have done well turning into NPA. I'm by saying that there are questionable asset quality, I'm not trying to say me and say that assets have been financed by banks by ulterior motives, but I'm trying to say that the reason for which the asset was financed, the reason rational on the basis of which asset was financed in 2007, 2008, 2012 might not be so valid as of now, because in a slow growth economic environment, the requirement of each and every good also tends to fall down. The pricing of those commodity goods also tends to fall down, and because of this, many of the assets that were economically viable in the past might not be so in the future, and they may turn into NPS. Second reason is, typically in the transition period from high growth to slow growth, high growth environment would also come with a very high inflation levels, which is typically not sustainable for a slow growth environment. So central banks typically tend to go with a high interest rate environment in the initial years, so that the interest rate can come at a much more lower manageable levels. Now, not all, as I said with my second point, NPS tend to be very high in the slow growth environment in the initial transition period. So high interest banks do not have that much capability of passing on those interest costs also as they had in the past, because in a high interest rates, high growth scenario, it was easy to pass on the interest rates to the consumer because he was earning a lot. So he didn't mind if he had to pay another 1% on his interest outgo. But in a slow growth environment in which he's getting hit on the margins, in which some of his project which he thought was economically viable is not no more economically viable, he might be he is living in a scenario wherein a small increase in the debt cost can make the project unviable. And because of this reasoning, banks cannot pass on as easily the uh, interest rate as they could have done in the past. So what does this mean as a conclusion for us? Banks, if you see, from 2002 to 2012, have enjoyed very high valuation levels than they have done historically. This has been true across the board, uh, not necessarily for American banks post 2007 crisis, but this has been true across the board. They have enjoyed historically very high valuation premiums. Uh, if you look at private sector banks, even private sector banks had enjoyed price to book value. If I were to take a case of two banks like HDFC and IndusInd Bank, they had enjoyed price to book value of 5. Sometimes back, even SBI used to enjoy a price to book value of 3. Now, private sector banks are tending to move towards price to book value of 3.5 to 2.3, and PSU banks are trying to come to a price to book value of 1 and below 1. And we believe that market is yet to adjust to a new reality. They are not yet factored in the fact that now we are going to move to a slow growth environment, and because of which we have to be very selective in picking up banking stocks. Are there good opportunities available in the banking stocks? Yes, there are very good opportunities available in the banking stocks, but not all of the banks can be painted with the same brush of undervalued. Some of the banks are, even when they on surface looks at price to book of less than 1, they may be actually be very overvalued because of the high NPA levels that they have. So we are giving a very selective buys on some PSUs, and as of now, we are at least telling to avoid private sector banks for now. Once they are available at decently good valuation levels, we would revert back and start saying buy for private sector banks. So this was largely what I wanted to tell you. If you have any questions on this, uh, I hope you have given those questions on your chat window, and I can start taking them now. Sorry. Uh, okay. Uh, so the first question is from, hello. Okay. Uh, Dear friend, just let me know that whether you can hear me. Yeah, thank you. Yeah, I would take some of your questions as of now. I'll look into what kind of banks we can suggest, and also I will tell what metal stocks we can look into. But first, I'll go through the questions based on the queries that you have submitted, and then I can tag questions that you are given in the chat. Okay. This first question is from Mr. Sushil Chandar from Kanpur. How long is how long is this bear market expected to last in view of the melting economy? Is it the time to invest or stay away? This is a very good question, Mr. Sushil. Uh, how long is this bear market going to last? I think, as I stated clearly, typically a bear market would tend to last uh, as long as it takes for market to understand that a reality of the environment has changed, that we have moved from high growth environment to a slow growth environment, and we have to start adjusting our businesses, we have to start adjusting our expectations along that line. Now, to take a case of India specifically, and I need to qualify my statement as such. Historically, it's not that in a slow growth environment we have not seen some countries grow at a very high rates, but these have been exceptions. To take a case of few, the two countries that had seen grow at a very high rates even in a slow growth economy was definitely South Korea and Taiwan. And one of the big reason was they because they initiated the export oriented policy. They had very good manufacturing policy, and because of that they could become in late 1960s, 70s and 80s the manufacturing base for the global economy, and they used their capabilities to move up the value chain. So if you see, typically most of the developed world economies have never grown beyond 3%. The thing because of which they become developed where because for a long period of time they can sustainably grow at 2 to 3% levels. uh, while the only two exceptions for this have been South Korea and Taiwan, which have tried to maintain for over last 30, 35 years a growth rate of at least 4.5 to 5% plus. And this is one reason why South Korea and Taiwan had become much developed much more faster than say probably Britain, US or France as such. It took a century for these countries to become to be called as developed world as such, and it took these countries South Korea and Taiwan to become developed countries into just 30, 35 years. So why am I trying to say this? If we were to hypothetically say that post 2014 election we were to get a government that was more focused on developing a very robust manufacturing policy, that was more focused on coming up with a good reform uh, policy, then yes, we might not see the growth rates of 9%, but even 5.5 to 6% in that kind of policy environment would be extremely good for us. It would be extremely good for the markets as such. There is not generally necessarily a direct correlation between the economic growth and the market returns. The reason for this is very simple. Uh, See, market return is not just a function of how good the economy is doing. It is also the function of how what are market participants' expectations. To tell you how I mean it, think this way. Recently, we have seen large amount of downgrade happening for GDP. People have started saying that Indian GDP growth rate will fall down to 3.7%. This was the number given by I think Barclays, sorry, BNP Paribas, and Jeffries, on the other hand, had gone ahead and said that Indian GDP growth rate can fall down to as low as 2.5 or 2.7 percentage. Now, when the expectations are so low, uh, if an economy were to do 5.5 percentage like growth rate, so let's say from 18 months from now, you can actually see a rally in this and a kind of a low growth economic environment also. On the other hand, if my expectations itself would have been 8.5, 9%, and the economy grows only at 7.5 percentage, the actually the markets can see very negative reaction to it also. So it's not just a function of how well the economy does, it is also a function of what the expectations are, because expectations tell you how low the stock market would be, or high, or how high the stock market would be, and with respect to that the expectations, it would adjust to the reality. So if we were to get a post 2015 a good government, and see, democracies typically act like springs. This is how bad things can go. We had seen this kind of thing happen even post Bofors also. We had seen that, and there was a huge disappointment within the economy. We had seen that we had lost hope, complete faith in the political class. And after that, what did we get? Did we get a strong reform government? No. We got a 2 years of a fractured mandate. And post that, we got a good reform government. And then we saw a good market rally. This again repeated back when in 1995 in the Narasimha Rao government, we saw again negativity creep back in policy environment, become too bureaucratic. There was paralysis in policy environment, largely because of lots of scam coming in. We had telecom scam at that time also. We had fodder scam at that time. Lots of scam every week were coming in at that time also. And did we get a strong government at that time? No. We again got a 2 years of a fractured mandate, and then we got a strong government led by NDA, which pursued reform movement, and we saw a phenomenal and a market returns at that time. Can something similar play out? Yes, I think it can similarly play out. But the point I'm trying to says there is limited amount that you can press a democratic country into. After that, it is a self-correcting system. The more it goes towards a negative, more likely it is going to throw out a much more positive verdict. And if things were to play out really well, I actually am on the other extreme. I think that in post 2014 we may actually see a much more stronger government coming in, largely because we have gone to a much more negative and scenario. We have moved from a growth rate of 8.5 percentage over last 5 years to a rate wherein we are now doing 4.5 percentage, 4.2 percentage, and wherein people's expectation has fallen down to 2.7 percentage levels. So I think we may actually see a very good and strong government come in post 2014. And let's say, what is the worst case if I'm wrong? Typically, if a weak government comes in, historically we have seen it does not last more than 14 months to 24 months. Post that, there is again an election, and that an election typically tends to throw out a much more reformist, much more stable government. And so, on the best case scenario, I would say the beer should market should not run beyond say May 2014, probably December or January 2014, if we start seeing that the election is going to throw out a definite win either for UPA or either for BJP. Uh, if things were not to happen that way, we get a fracture mandate, and in the fracture mandate, it's a weak government that cannot make any decisions. And I think that the worst case that is going to play out is maximum March 2015, because market would start factoring that this government is now going to demise within the next 12 months. So it would start factoring that, and would start factoring the fact that more likelihood of a strong government coming out now. So this is the worst case scenario that I have painted out to you for a bear market. Having said that, a better strategy is always to look at is are they beaten down sectors, because I have seen that beaten down sectors even tend to give extremely good returns of 50 to 100% returns even in the worst case of the scenario. To take a case in point, BHL, if you would have invested in the beaten down time of its 100, you would have been sitting in 40% returns as of now. Can it still go back to 100? Yes, post probably its October results. I believe that another second wave of weakness can come for BHL again. But I would use that for buying into these kind of companies. Same was with NMDC and say Hindustan Zinc Limited. We saw them go down to as low as 96. But even if that time, if I would have bought, we would still be sitting in 25 to 30%. Now, yeah, there is argumentation to say that things look very clear once and it's in history. But the point, hello, uh, am I audible? Yeah. But the point that I'm trying to make it is whenever you find companies that are at a very low historical valuations and wherein there are fundamentally nothing wrong happening with the company, even in the bear market, they may tend to give you very outsized returns to you. I hope that answers your question. Let me know if there is something that I should take forward with you. The next question is by Mr. Baswa Raj. His question is economic situation bottomed and future about Indian rupee? How much down Indian rupee can go uh, according to fundamentals of Indian economy? Now, this may come as a very surprise to you. I don't think Indian economy on a fundamental basis should go anything below 60 bucks. But it has gone below 60 bucks. Now, I would largely call this largely because of the irrationality of the market. If you were to see how uh, low currencies have gone across the board in the economy. I think the Japanese currency has depreciated a lot, largely because of the active policy of the Bank of Japan to depreciate it so that it can result in a much more better exports from the Japanese economy. The next currency would be Indian. So Indian currency is today the most beaten term currency even after factoring for the fundamental reasons. If you were to ask me, I strongly believe that within the next 12 months we may see a scenario wherein we may come back to a level of 60 to 61% rupees at back. We might not be seeing 70 72 probably somewhere in December 2014. Can 70 72 be touched? Probably it may happen because of some panic by FIS, because of which they start pulling out money, because of panic by Indian industrialists, because of they find that it is more makes more sense to invest outside of India rather than in India. So most of the profit that they make in India, they would start investing outside of India, and because of which the rupee may depreciate. But if let's say lastly, if Mr. Raghuram Rajan is largely capable over next say 14 months, he can pull down the inflation rate to 4.5 to 5%. I see no reason why rupee should hit anything above 60 61 rupees. Uh, has the economy bottomed out? I don't think so. The reason I don't think economy has bottomed out is coming from two major factors. One, uh, uh, while government has started some taking some actions on say releasing some releasing clearances of project, we must give benefit to this government also, that over last 2 months they have released about 1.7 lakh crore worth of projects that were just sitting with various ministries because of lack of clearances. Now, because will this start giving benefits to the economy immediately? No. Much of these projects are capital intensive in nature. They may take about 2 to 3 years just for executing them. And because they have been in limbo for such a long time, even the companies may take another 4.5 to 6 months to just reinitiate them. So has the economy bottomed out? No, but I think we can start looking at some of the initial signs of saying that we may have seen the worst. Yes, there is still much more worse that the economy can go, but it's not too far bottom that we are looking at. So can the economy go down to say 2.5 percentage GDP growth rate? I don't think so. My large thinking is that economy should bottom out somewhere around 3.8 to 3.75 and a GDP growth rates, and from there on, I think an economy should start and re-pulling itself back. But I also do not foresee we going back to 8.5 to 7.5 percentage level or 6 percentage level. I think the best case scenario for us is over next 4.5 to 5 years, we will be seeing a decently good 5.5 to 5 percentage growth rate, a sustainable 5.5 to 5 percentage growth rate, and which would not necessarily be a bad thing if it is accompanied with an inflation of say 3.5 to 4.5 percentage levels. Uh, The next question is by Mr. Padmanabhan Shenoy. His question is, what are your views on banking? PSU's bank have been beaten down. Is it better to sell and contain losses, or is it good time to average out? Example, IDBI Bank, Bank of Baroda, Canara Bank, Union Bank, SBI, IDFC. I think your question is largely with respect to PSU banks. I would take the views, I'll try and give you the views on each of the banks that you have mentioned, but I believe your question is largely with respect to PSU banks. Uh, I think my much of my question would have been answered in the much of your question would have been answered in the presentation. Uh, the thing that I would like you to focus on is While PSU banks seem to be very beaten down as of now, not each of the PSU bank is necessarily at a discount price, because in the sorry yeah, because in the recessionary scenario, you have to assume that NPS would start increasing, that some of these NPS would never become even after restructuring, may never become performing assets, and this would result in a write down in their book value. So when we did this exercise about a month back, and because of this, now you are seeing some of the buy signals also coming in for some of the PSU banks. I think we have already given buy signal for two of them, PNB and SBI, and I think you should be getting a buy signal for Canara Bank as of today. So some of the banks we are very optimistic about. Uh, we should be probably within a week time also get a buy signal for Indian Bank. We are just trying to see it on a technical basis. But if I were to tell you on a fundamental basis, all these four banks looks quite phenomenally attractively priced to me. But take a case of Union Bank of India. I do not see that even at the price to book value of 0.3 to 0.5 that some of these banks are trading at. These are necessarily deep discount banks as of now. Because when I adjust their book values for the NPS that they have, so meaning I deduct the book values with the NPS that they have outstanding. Next, banks typically have to maintain certain amount of capital if based on the percentage of loan that they give. So the mandated requirement by the Basel norm and RBI is about 9.5%. What does it mean? So when a bank gives out you a loan of $100, he has to at least maintain on an average another 9.5 rupees aside for, so that if the loan were to default, this 9.5 rupees will cover it up for it. Now this does not work necessarily in each case, but then you do not expect each of the loan to also default. So the this corpus that the bank starts creating by keeping this in a uh, risk weighted asset tends to help it during these kind of scenarios wherein the uh, loan starts and a default loan start defaulting, they start becoming NPS. Now a bank has to maintain about 9.5% irrespective of whatever the cycle he is in. Now you may have been hearing that the finance minister had budgeted about 20,000 crores to be funded to PSU banks as a sort of rebuilding their balance sheet, strengthening their balance sheet. Now, why is this required? This is required precisely for this reason, and because if the bank cannot grow, if it does not has adequate and a net worth to support that particular kind of growth, and if bank does not have that adequate kind of network to support additional credit disbursement, then you typically see that the credit disbursement level will be low. If the credit disbursement level is low, typically it would result in low consumption and low asset creation, which results in a low GDP growth rate. So the fallout of this is that many of the PSU banks may see a large NPS because of which their book values are low. They may also see a large dilution because the government may have to end up buying at a very low price to book value, which is generally very negative to minority shareholders. And this may result in that these stocks, even at 0.3, 0.5 price to book value, might not be very attractive to you. Uh, so we will be coming out with notes on each of these banks specifically. There are specific opportunities available for some very good PSU banks. To name a few, I think PNB, SBI, Canara Bank, Bank of Baroda, and Indian Bank look very phenomenally valued. Our technical analysis trying to see if there is a technical basis of giving you a very good buying opportunity. However, if you have a risk appetite of seeing 10 to 15% correction, I think even at current prices, this may be a very good buying opportunity. But please be aware that our technical analysis is monitoring these banks for you, and if and whenever this a good buying opportunity is available based on both fundamentally sound companies that looks into technically bottoming out of these companies, then you may start initiating coverage in those. Uh, uh, about IDFC, the follow-up question that you have asked, Padmanavan. Yeah, Naveen Kumar, I lost the language that I have taken. About IDFC, see, IDFC is not necessary, is not banking, it is much more a infrastructure development company. Now, if you look at the balance sheet of many of the infrastructure development companies, even the big ones like L&T, they have very stressed balance sheet. And I would be, that's why, very circumspect of investing into IDFC as of now, because much of the IDFC loans would, while uh, secured against an infrastructure assets, are given to companies that have very low cash flows. If you have been following news, you would have heard that Lanco is firing about 4,000 people. Balance sheet of L&T is very stressed. It has not been making good cash flow from operations for about now 3 years for now. Uh, Same is the case with GMR. GMR has not been making much of money. So many of balance sheets of many of the infrastructure companies is very, very stressed. And that is one big reason I would tend to avoid IDFC for now. Let's see if we get IDFC at a very good price, and which is, after adjusting for such kind of risk, also if it makes sense to us, probably we can enter into those banks, into IDFC again. Uh, uh, should we sell IDFC? Padmanabhan, let me take my technical analyst view, and probably I will get back to you, because you are asking for a very short-term price correction in. So if there is a short-term price correction in IDFC, I would proactively let you know that there is a short-term price correction in IDFC, and you may exit IDFC, and probably then you can re-enter at a lower price. Naveen Kumar, the companies that I spoke about was SBI, that is State Bank of India, Punjab National Bank, Bank of Baroda, Canara Bank, and Indian Bank. On a technical and fundamental basis, we have released buy signal for Punjab National Bank, State Bank of India, and Canara Bank today. The next question is by Mr. Devji Patel. His question is, stock like NMDC, BHL, Bank of Baroda, and Punjab National Bank, how many percentage maximum drop from DP price? And it is advisable to hold for long period, and in current market, what is your opinion for these stocks? Devji Patel, I don't know whether you sat with us for the last webinar that we had on cyclical companies. Now NMDC, BHL, and we are now coming to view that even PSU banks are cyclical in nature. Uh, while I think it is clear for most of you that why metal companies are cyclical in nature, because metal companies tend to there is a supply and demand case in it. When metal companies typically take 5 to 7 years to build a new asset, so when they try and predict what would be the case in about 5 to 7 years from now, there is much more likelihood of they getting it wrong, and there is much more oversupply that gets created in the market, because of which the prices also tends to fall down. Many times this kind of growth is financed through debt, so the profits tend to fall down at a much more large rate than the way revenue falls down, compared to the way the revenue falls down, and this gives a cyclical nature to their business model. On the capital goods companies, uh, in the any economy goes through a period in which it creates capital goods, capital assets, and then it tries to assimilate those within the economy, in which the demand for those capital assets tends to fall down, and then again it will, and the demand for the asset will tend to outstrip it, and again it would have to tend to create capital goods, capital assets again. And because of this nature, uh, capital goods companies tend to be cyclical in nature. So think this way, even if we didn't have power sector problems, what would have happened is we would have created power sector companies to such a large extent that India would have become a power surplus country. And because of this, the margins that the power companies are maybe seeing may turn to be very low than what they would see at the start of their business cycle. And then over a period, what would happen is the power sector company would stop creating new power sector plants, and eventually Indian demand for that power sector would again start and outstripping what the power sector companies are producing. Once the demand starts outstripping the supply, power sector companies would again approach capital goods companies to create new power plants for them. So again, capital goods companies also tend to behave like cyclical companies. This is very extreme for metals and mining companies and capital goods companies. Can this be argued for each and every company? Yes, but for most of the companies, the variation in their profitability is not so high, because these are largely very high capital asset based companies. A small change in the revenue can create large changes in their profitability. This is not necessarily a case with the FMCG or a pharma company, which can adjust their cost structure very fast to a slowing revenue growth. on a PSU bank, it's not a necessarily a demand supply scenario that plays out. It is much more interest rate cycle scenario and economic slowdown scenario that tends to plays out, because of which in the slowing economy you tend to see a rising NPA levels. Let me see if I can take you through a company to make this understand. Let's take Punjab National Bank itself. If we were to look at NPA profile, you would see that the NPA itself would go through a cycle. So if you see, NPA was at a very high level in 2004 uh, compared to what is in 2005. Now, 2004 was a period in which the Indian economy was just trying to come out of recession. I would 2003, 2002 would be much more worse number than what was in 2004. Then the economy starts becoming better. But in the pursuit of growth, Punjab National Bank ends up giving another loans to companies that might not be necessarily good. 2008, we see a financial crisis which results in a much more higher NPA level. But India does not get hit as badly as we thought initially. So NPA is not that bad. But in 2012-13, when really when things start going very bad for for banking companies, you see NPA levels start increasing again. Now this cycle is much more visible at a gross NPA level rather than at necessarily at net NPA levels. But net NPA level will also show you that kind of phenomenon. But it will be more visible for a gross NPA level. Now, having said that, it's not advisable to buy a cyclical company at a DP. Why? Because in a scenario in which things are going bad for the company, market would tend to become extremely pessimistic about it, and they would tend to think that this kind of a high NPA, low net interest margin scenario, or a low margin, low metal price scenario will continue for indefinitely, and which does not happen so. And because of this, the market price can fall substantially below DP. We do tend to model and see what is that kind of price, but we have seen that market expectation of that can go even much below that. So we have been wrong at times at giving an buy signal to some cyclical companies at quite early stage, but we have been now much wiser, and now we tend to give buy signal based on both a very high worst case scenario modeling of an cyclical companies, and on that we try and see if now it makes a long term technical sense also to start buying another stocks. So I do not advise you to buy metals or mining companies necessarily at DP. I would rather advise you to wait for a buy signal coming from our side, especially for cyclical companies, and then buying the stock once the buy signal has come. This does not plays out necessarily for stalwart. So you have been seeing Asian Paints also coming down very fast, but it's a stalwart. Its business model does not necessarily gets impact because of slowdown in the economy, because it has a very strong brand. It has a very strong supply chain and distribution model. So it tends to do well even in a slowing economy. Plus, it has much more ability to pass on margin. It is not a commoditized product, so it has much more ability to pass on margin. So its profit is much more well maintained. So it is much more better to buy into stalwarts or in a fast growing companies as at DP or based on our buy sell plan. The next, I hope that answers your question. Uh, Ravindra, next question is by Mr. Ravindra Kumar. His question is it worth buying Navali Lignite at current market price, or should I wait for more downfall? Now let's look at Navali Lignite first. Navali Lignite is a very good company. It is has very good lignite asset based, and which it both sells as well as uses it for its own consumption to do to generate power. Now there has been some reason why the market price has fallen down below DP. One large reason has been because of the strike at Navali Lignite, because employees were protesting disinvestment. Now we know that it has largely been agreed that the government, central government, will sell its stakes to Tamil Nadu government. Uh, we believe it is available at a very good discount. Uh, Yeah, you can still look at buying at current levels, but I would rather advise you to keep a lookout for our technical view, because the technical view is trying to predict a long-term turnaround in the pricing of it. But yes, at this current prices also, our pricing looks very attractive below our discount price. The only thing I would like to advise you is to wait out, keep an eye out for our technical signal, so that we can arrest the downside in our portfolio because of it. The next question is by Mr. Naveen Kumar. His question is, tell me the best five stocks that can give better returns, and also explain why you select these five stocks. Uh, okay, if you were to ask me five best stocks that I would like to select, I would like to keep it across and all beaten down sectors. So metals and mining, they have been beaten down a lot. So I would like NMDC, Hindustan Zinc Limited, or companies like Moil or Coal India. These are the four types of companies that I would like. You can pick and choose any one of them. I am indifferent in most of them. With the Moil, just I would like to caution that it produces manganese, and manganese is more dependent on steel. So it may take much more long for you to get the returns. But if you ask me on time adjusted basis, I'm indifferent between all these four companies. I i personally have all these four companies in my own personal portfolio, so I'm indifferent between all these four companies. You can have any of these two companies in your portfolio. If I were to speak about another sector, that is bank, I like to especially in the public sector banks, I find very good opportunities. So I tend to like Indian Bank a lot. One big reason is its dividend yield itself is 10 percentage. Those of you who have been visiting me on webinar may know that I am the whole site is much more value focused. So we love Indian Bank as such. It gives dividend yield itself. Even today is in a 10 percentage. Uh, After doing lots of risk testing for an Indian bank, after adjusting for NPA and dilution, I still see that the current price is unjustified, and so I think that even over next 14 to 18 months, once the market panic with respect to bank may get stabilized, Indian bank may actually do well. Uh, so I tend to like bank. Within the cement sector, not yet, but sorry, within the cement sector, not yet. But if I were to get it at that price, I tend to like ACC. We have done a very in-depth valuation of it based on discounted cash flow basis. We are and unlike discounted cash flow valuation tends to be very stable for quite a long period of time. If you were to just look at the price chart, if I were to show you the price chart, if you see, we have maintained this valuation since December 26 to January 6, 2012. We have maintained this valuation, and if ACC I were to get it near to my DP, it is very close by. If I were to get it near to my DP, I would tend to like ACC also. So within the cement, I would tend to like ACC much more than Ambuja Cement or an Ultratech as of now. Uh, uh, Within the capital goods, I like BHL a lot. I think BHL has been an interesting case since price of 100, and since the time it has touched 103. The only caution that I would like is I expect a weak than expected and results in the September numbers, which the result should be out somewhere around the end of October, and that may give one more and a negative and a push to the BHL stock. If I were to get that company at some anywhere close to 110 to 120, I would tend to add it to my portfolio. Uh, uh, this is as of now looking at what the results are. If BHL turns into loss, then I see a bottom of around 80 to 100. So I would keep a very large range in between 80 to 120 in which to add that stock. I would do a very slow addition of the stocks. But 100 is something that is very attractive price to me. If I were to get it at 100, 100 would be a very attractive price to me. The last time when it was at 100, I bought it for my own portfolio. So that is the disclosure I would like to make. So BHL is one very good stock. The reason I like BHL is that if you believe in India story, that India would do some even somewhat good than what it is doing today, you have to have BHL like company in your portfolio, because as of now, when I look at the Indian economy, I look that the power sector is the biggest constraint in the Indian economy for growth, and one of the big beneficiaries in breaking down that constraint would be BHL, because without building new power plants, it's not possible to sustain a 5 and 5.5% kind of growth, because right, both my manufacturing needs and that kind of is and needs and power surplus in India, my cities need power surplus in India, my agriculture needs power surplus in India. It- if you believe in India having a decently good future, company like BHL will tend to do well. Will it tend to do well? Say uh, immediately, I don't foresee that. I think anybody who invests into BHL needs to have a staying power of at least 18 months. But given the fact that it is available at a historically very low valuation, I would not be surprised that even from the current levels, it tends to give me 50-60% returns over next 12 to 18 months. But I just would like to caution you that it is a cyclical company. We are going through a bad policy economic phase, so this return may take some time to come. You need to have the staying power while investing in BHL, and open to the fact that the company may even see the price range of 80 to 100 again, and that kind of pricing should be used to and buy into the company rather than panicking and not buying into company like BHL. So in capital goods would be BHL, in cement it would be ACC, in metals I've already given four companies. To repeat, NMDC, Hindustan Zinc Limited, uh, MOL would be the type of companies that I would be very interested in. Are there some very cyclical multi-baggers that are coming in? Yeah, there are in within the metal sectors, but I would try to look at once they are available at decent prices, I will get back to you. So we have got three sectors. These are the three sectors that have been beaten down a lot, and that's why I tend to like these companies as of now. Within the pharma sector, Lupin has been performing decently, both in getting FDA approvals and getting this. If Lupin were to available to me at anywhere below my MRP, if because Lupin is also in our buy sell plan, if Lupin were to available in anywhere close to my below my MRP based on my buy sell plan, I would tend to follow buy sell plan and add that company into my portfolio. Another good company that is currently in my as per my buy sell plan is also into this is an Asian Paints. uh, if you see over last few weeks, Asian Paints has been weak and it has been tending to follow. Anyone who has been following our buy sell plan should have bought Asian Paints into his portfolio. And I think within the next 6-7 months, Asian Paints should give a decently good returns. Do not expect extremely good returns, but I think Asian Paints is a type of company that if we even buy at let's say 5 to 6% below our MRP, should end up giving us at least 15% and a return each year on year. So Asian Paints would be another type of company that would give a very good anchor to my portfolio as such. So these are the type of companies that I would be very interested in adding to my portfolio. The follow-up question by Mr. Naveen Kumar is Berger Paints and Asian Paints, which one would you prefer? Uh, I would prefer a market leader as such. Let me have a look at Berger Paints first. Hmm. Yeah, I would prefer Asian Paints as of now over Berger, because it is one available at below my MRP price. While both of the companies have done extremely well as far as their financials go, but based on our valuation, I think I would go with my valuation of Asian Paints as of now. Yeah. The next question is by follow-up question is by Mr. Kamalakar Chaudhary. His question is why BHL did not come in by recommendation as of now. One of the big reasons why BHL didn't come as a buy recommendation is because our technical analyst had a view that there was still some weakness left within BHL. Plus, we are still waiting out for the September result. We believe that while BHL has run up extremely well, no denying that fact, BHL has run extremely well over last 3 weeks. We still believe that the September results can show a negative surprise, and if we do not see that surprise, we would actually come out and give out a fundamental buy signal also. But we want to actually wait for the September result, see to get a confirmation that yeah, this is a good time to get BHL. Uh, did we miss a bottom? If the results have tend to be very good, then I think we have missed a bottom. But if the result turn out to be a negative surprise, then I think there is one more bottom that is left in BHL, and we would you should be getting a buy signal around that time for BHL also, because I think that would be one of the last leg within the market would lose, have another round of losing faith on BHL, and that would be a good time to buy into BHL as of now. So that was one big reason why BHL, we didn't give out a BHL at the price of 101 or 102 that BHL had come at. Kamlaga Chaudhary, I would just like to clarify, yeah, we have missed out 40 percentage of upside on BHL, but it is against a caution that September results we are not expecting to be very good, and there is a good likelihood that we you may see a very good opportunity again coming back with BHL. If I am wrong with my assumption of BHL, probably then we should go full hog and invest into BHL. But based on the fact that I'm not seeing lots of order inflows coming in, I'm not seeing lots of project execution happening. Uh, I think that there is much more more likelihood of BHL coming up with a weak set of numbers post September results, and I think that we should see a much better pricing than what we are seeing even currently as of now. The next question is by Mr. Abhishek Deshmukh, a follow-up question. I think his question is, if I were to prefer in between Punjab National Bank and Bank of Baroda, what would I prefer as of now? I think I would prefer Bank of Baroda as of now, but I'm largely speaking not much. I'm largely speaking indifferent in between both Bank of Punjab and Punjab National Bank. For Punjab National Bank, the only question I would add is people who are entering at current prices need to be open to the fact that the prices can come down to as low as 390 or in between 410 and 390, and they should use this price range to buy into the portfolio of the buy company like Punjab National Bank into their portfolio. Uh, Naveen Kumar, you have bought BHL, EIL, Punjab National Bank, Indian Bank, and SAIL as per our advice. I don't think Indian Bank is at a very negative based on my advice. When we gave it in the last webinar itself, we cautioned that the buying range for Indian Bank has to be in between uh, 68 to and a 58 kind of a price scenario. And if you have used that kind of buying range, I don't think an Indian Bank has given you sale, yeah, things have gone wrong with the sale, but I think sale would be a good multi-bagger to you. Uh, there will be a price point that we would be releasing buy signal again for sale. That would be a good price point to average out sale, and sale would give out a good phenomenal return to you. So yeah, it looks bad that you have sitting on 40% and negative returns on sale as of now, but the one thing with sale is that I would like to let you know upfront is sale would do extremely well over next 5 years. The only thing that you need to see is that sale itself is trying to double its capacity. It has all the land that it needs. It has all the mines that it needs to build that kind of capacity. It is not building a crude steel capacity. It's building a much more higher value added steel kind of capacity. And so I foresee much more higher and better margins in the future for sale, and much more better revenues for the sale. And because of this, I think sale would actually tend up to be a multi-bagger even if someone buys at this price point. But the only thing I would advise is, even at this current price point, I see in a 37, 38 price as much better price to enter into sale, and that can be a price at which we can think of averaging as of now. But please wait on for our buy signal for the sale. Once we come out at buy signal, I think you can average it. You are in a pricing at that time. Yeah, Ashok Kumar sir, you are rightly pointed out, because we are going through a very interesting times to say as such. We are going through a times in which we would see large market volatility. At least for the next 6 months, I would tend to caution that if you are trying to enter into banks and cyclical companies, please look out for a buy signal before trying to enter into those companies, because we are trying to do a lots of worst case scenario modeling to look at what is the best price to buy into the company. But if you are buying into a stalwart, by going through and buying them at DP, or going to through a buy sell plan, is more than sufficient for you. It will work out extremely well for you based on our modeling. But that for companies that are in cyclical in nature, they would I would suggest you to please wait and look out for our buy signals, because these are coming after extensive analysis done by us, and that should be much more better buy signal for, and should tend to have much more lower negativity to your portfolio because of it, because of the current and high volatility in the market. uh, Kamlaga Chaudhary, we have done the first. Your question is, what happened about the proposal to put up model portfolio based on the philosophy of Peter Lynch for not so active investors? We have finished the first phase of the Peter Lynch based model portfolio, that was an actively identifying which of the company is cyclical, which of the company is stalwart, which of the company is growth. The next phase would be wherein we would start requiring much investors interested in this kind of a product to start giving out and to filling out our risk questionnaire, because I have to identify what kind of a risk profile you are, both based on your risk ability, that is your economic ability to take risk, and your psychological ability to look at risk. And based on that, once we have finished with that framework, we would start giving out a model portfolio. We had done a trial run in the month of February. This was done to get as a set of data which can then be analyzed and researched upon by us to give you a much more better model portfolio as such. We are moving towards that direction, but developing a model portfolio for individual investors is a much more tougher task. So it would take some time. I think it would take at least 2 to 3 months at least for us to start giving out a model portfolio that is customized to each and every investor's risk profile. The next question is by Mr. Mahesh Asrani. Just The next question by Mr. Mahesh Asrani. Uh, is question, in case of US attacks Syria, what will be the impact or effect on ONGC and banks, specifically private banks like ICICI, Axis Bank? A very good question. If US were to attack Syria, if it were to be a short-term event, I would not worry much, because while the crude prices may tend to move up very fast, because it is a short-term event, unlikely to last very long, uh, crude prices would also tend to correct very fast. One of the big reasons why US has been attacking is looking at attacking in Syria is not just chemical weapons. We need to be aware of the fact that a a government that is compliant to uh, that has much more better relationships with, let's say, Saudi Arabia and Qatar, opens Saudi Arabia and Qatar energy markets to the Europe also, because Saudi and Qatar can both use Syria as a port base to as export energy into Europe also, which as of now goes through a much more longer and navigation route. We need to be open to that fact also. So, if it's Syrian engagement of US were to be a short-term affair, I would not be much worried about it. But if it were to increase, it were to a much more longer duration engagement, the way US had with Iraq and with Afghanistan, then there is a cause of worry, because that would mean that crude prices would tend to be at 120 plus levels for a much more longer period of time. That would result in a much more higher level of fiscal deficit for government of India, especially if it decides to absorb that and high crude prices, this being an election year, rather than passing it on to the customers. If it were to pass on to the customers, while initially the inflation would take a huge hit, but eventually things would start cooling down even for India as such. uh, but if government were to take that fiscal deficit hit on its own, you should see interest rates starting to increase again, and it would be extremely negative for banking companies, because the cost of borrowing increases. They would try and pass on that cost of borrowing to initially to the customers, which would result in a much more credit disbursement, much more lower credit disbursement than what they have historically seen. So you should expect many of the private sector companies to adjust to a much more lower valuations if an US were to attack Syria as of now. On ONGC, ONGC is a much more tricky. Uh, uh, the reason ONGC is much more tricky is crude price increasing necessarily does not always works out in a benefit to the ONGC as such, because ONGC has to share a large amount of subsidy burden out of it. So crude price increasing is only as good as and the amount of that crude increase can be passed on to the end consumer for ONGC. So if let's say crude price were to increase by 10 percentage, and petrol and diesel prices were also to increase by 10 percentage in the next few weeks following the attacks, then it is extremely beneficial for ONGC, because then ONGC starts getting a much more higher pricing. If, however, if the crude prices increase by 10 percentage, but petrol and diesel prices do not increase by 10 percentage, ONGC still tends to get a very low and value to the crude that it produces, and that is not beneficial for a company like ONGC. So ONGC is much more tricky to look out for. It's not Syria attacking, sorry, US attacking Syria, extremely sorry for saying it in the opposite way. US attacking Syria should result in a negative blip on ONGC as such, but we should wait out for seeing what would be government action. If government comes out and says that they would use this opportunity and pass on the cost to the end consumer, then ONGC makes a very good case for investment. If the government does not develops a case for passing on those costs to the consumer, then we may need to be a bit cautious while investing into ONGC as of now. Um, the follow-up question is by Mr. Ravindra Kumar Chitturi. His question is, uh, uh, can I accumulate South Indian Bank for long term? How is the view of Syntax presently? Is it a long term? Is it a buy for long term, or wait and watch? Can it make or out from the current scenario? Uh, I'll take the syntax question first. If you look at syntax, one of the big reasons why syntax has not been doing well is because of the high debt that it has in its books. Yeah. Uh, Now, because this is a, as I have laid out a framework to you right at the start, that I am foreseeing a much more higher interest rate scenario. So we should expect Syntex to do much more worse for some more period of time, because in a high interest rate scenario, the debt burden that Syntex carries would hit it more. Having said so, Syntex also sits on a good cash balance, and this cash balance should mean that it might should not go bankrupt as such, but it would definitely result in a very low and a profit growth environment as such for Syntex. Among the people who have most leveraged balance sheet from across all sectors, so I am taking companies like Suzlon in wind energy, Hindustan Construction in construction, and Tata Steel and Hindalco in the metals. Among those people who are most leveraged, I think Syntax is much more better place to come out of this kind of a negative scenario. One, because it has a very good brand. Second, its problem is largely working capital related rather than it trying to create a new huge asset whose economic viability might not be certain, and its working capital is much more related to government, to a large amount of cash that is restricted in the product segments that caters directly to uh, directly to customers who pay out based on the benefits that they get from government. Uh, so, if the fiscal deficit scenario, if if Chidambaram were to meet 4.8 percentage of fiscal deficit scenario by doing large amount of disinvestment, by passing out the fuel increase cost to the consumers, I think Syntax is much more better place to come out of it. But if the fiscal deficit scenario tends to keep on worsening, then I think I would be cautious with Syntax as of now. As of now, because Syntax has already fallen down to 18 bucks, and if it is not a very large part of your portfolio, I think it may make case for you to keep on holding Syntax, because at least Syntax has a possibility of coming out of its portfolio. However, I see much more better opportunities at other places, and it may make sense if it is a large part of your portfolio to start accepting that Syntax that we made a mistake while putting our money into Syntax and get out of it. Syntax is a very high risk strategy for your portfolio. If it is a very low percentage of your portfolio, you may keep on holding it. But if it's a large percentage of your portfolio, then I think you need to get out of Syntax to a large extent as far as possible. I, your other question was with South Indian Bank. Let's have a look at South Indian Bank first. If I were to point out some of the weaknesses of South Indian Bank, it has very low CASA ratio, and its NPA has deteriorated a bit as of now, but it is tending to maintain a decently good and a net interest margins, uh, not very high, but decently good net interest margins. So I think you can keep on holding South Indian Bank. However, I think you should try and look at South Indian Bank much more closer to DP, and not above DP. Below DP, it may make a much more better case to buy into South Indian Bank. So as of now, avoid, let the South Indian Bank come down below DP, and then we can look at it. One thing that I would like you to point out is our operating philosophy thinking as of now is that we are foreseeing at least a 10 to 12% correction even from current levels. Will it happen immediately? I don't think so. We may see a uptrend in the market, but definitely by the end of year, or some probably somewhere end of January 2014, we are seeing that the Nifty would definitely make another low. So we are thinking that we are of the opinion that it should be largely possible that we should see a 4,700 to 4,800 kind of pricing of a Nifty value play out. I think that weakness would be the time when I would tend to look at companies like South Indian Bank and other banks, so that I get them at a extremely good valuation levels. So if you have South Indian Bank, you may keep on holding on it, but I think you may, if you are planning to add on it, I think it's not a best time. I think you would get a much more better time than some 3 to 4 months down the line as such. The next question is Mr. Baswaraj Kalupur. His question is not stock related, but much more on a financial uh, portfolio related. He says that he has a loan of 35 lakhs and he is paying 15% interest rate. What should he do? Should he invest in market or should he reduce the loan? Uh, I would give a solution to you that is in your interest, not something wherein I would tell you to go and invest in equity markets first. I would think that if you have a loan which is giving you 15% interest, which is charging you 15% interest rate, I think your first job should not be investing into equity market as such. Your first job should be to decrease your loan as far as possible. Probably some amount you may invest into equity market, but largely I would say please avoid investing into equity markets. You are sitting on a huge liability, which itself is has a is charging you at the rate 10%. See, or broadly, if you look, equity markets have tended to give not more than 15% in returns for a long-term investor. If he invest into uh, indexes. If we were to be, if only if you were to be extremely good investor, following a disciplined manner of investing, he tends to get another anything in 3 to 5 percentage more, so that his returns can be around 18 to 20%. Only if he can consistently follow a disciplined manner of investing over long term, he can get that. Given this kind of scenario, I would rather suggest that you please cut down on your loan first. Once the loan part becomes very bearable for you, then we can start looking at and developing a equity market portfolio for you. But cutting down on your liability is the job number one that you have to do as of now. The next question is by Mr. Stephen Collis. His question is, what is the benchmark for buying banks in the absence of value creation index? Uh, One reason why we have been actively searching out for a value creation index and we have not succeeded as of now is that banks are a different animals as a company as such. If you look at bank, a typical bank tends to have uh, if I compare it with even the most leveraged company, a typical bank would tend to have 3 to 4 times more debt on its books. So if a normal company is leveraged 1:3, meaning there's 3 times more debt on its book compared to its equity, a bank would have anything in between and a 7 for a case of a company like HDFC to and a 20 for a case of a very mid-tier PSU company. Even for SBI, it is around 17. For Yes Bank, it is around 17. So it is extremely leveraged companies. Second, unlike for most companies, for banks, cash itself is like a raw material. If it has cash, it can lend it out to the people. It is not like a cash sitting on books for other companies wherein it can earn interest. Cash itself acts raw material. So developing a value creation index for banks is a very, very tough task. One very good proxy that, though I think for a that should work out as value creation index is, if you look at ROE, you need to have a bare minimum ROE of at least 15.5 to 16 percentage for a company. If it can manage a 15.5 to 16 percentage ROE for a sustainably long period of time, that should stand as a good benchmark for any bank. How I have come at 15.5 to 16 percentage is, if you look at any bank, even one of the worst banks tends to make around 14.5 to 15 percentage as a ROE. So keeping that as a benchmark, that it has to at least qualify for 15 percentage as a ROE, I think would work out extremely well for as a value creation proxy. But yeah, we are working on looking at what would work as value creation uh, for a bank. I think a simple metric like ROIC minus WACC might not work for a bank, because I have to look at not just how whether he's getting returns, but also how much riskiness he is bringing into his portfolio, which is better analyzed by looking into his NPA profile and his capital adequacy ratio. So I think a scoring metric may work out much more better for bank as a value creation index rather than this. We are working on developing that, but till that time, I think looking at ROE or for a bank which has 15.5 to 16 percentage more for identifying a good bank should work out well for you. At least a 15 percentage is needed for identifying a good bank for you. One of the question is by Mr. Abhishek Deshmukh. His question is about ITC with promoter holding being very low. The reason promoter holding is very low in ITC is not because there is anything shenanigan happening in ITC. It is largely because there is no promoter as such. There used to be a promoter called as British Tobacco Company quite uh, at the early stage of its of the company, but I think they were in somewhere in 1980s they were as promoter, but they exited as promoter of ITC, and for last 25 to 30 years ITC has been a purely professionally managed bank, and it does not has any promoter as such. So I don't think this should be a cause of concern for a very good professionally managed company like ITC. It should not be a cause of concern. If you look at another company similarly, L&T also does not has any promoter. This, there used to be a promoter. Tata used to own it. Then that was owned by uh, that was bought over by Reliance during the times of Dhirubhai Ambani, and when Dhirubhai Ambani was chairman of Reliance, he was also elected as chairman of L&T in early 1990s. But then they exited it and they sold it to Birlas. And then Birlas and L&T, they broke L&T into two parts, in which one of the cement part became Ultratech, and the engineering part continued to remain as L&T. So if you look at L&T also, L&T also does not have any promoter stake, but this has been so for L&T for also for quite a long time. Not having promoter stake in itself need not be a negative for companies that have performed extremely well for a consistently long time, and they have been well managed, professionally speaking. Naveen Kumar, we are working on this. My IT team. Your question is, can we have added new feature like stalwarts, laggards, etc. Can we filter only stalwarts as of now? My IT team is actually working on developing a filter so that you can filter companies based on stalwarts which are available at, let say, DP, or cyclicals which are available at below DP. We are trying to develop filters for that. My IT team is actually working on it. I think within a few months you should start seeing that kind of filters also in our website. The next question is by Mr. Padmanabhan Shinoy. His question is regarding the four PSU banks where you said you have issued buy signals. Is it that the valuations have been tested by all for likely impairments from the restructured assets, and on adjusted basis they are worthy buys? I would like to show you a exercise, part of the exercise that we had done, so that you can get a view. Let me see. Now, what we have done over here, it would be very hard to understand, so I'll summarize it briefly. What we have tried to do over here is we have adjusted the net worth with respect to the NPAs that that are in the bank that have not been provided for by the company, and we believe that in many of the cases those are the extreme levels of NPAs that we are seeing as far as percentage levels goes, and then that we have found that adjusted price to book value. Now, because some of these companies also have uh, cap, CRAR, that is capital risk adjusted ratio, much more lower than what the Basel one requires. The Basel one, and which is mandated by RBI, is near 9 to 9.5%. Many of the banks have less than that. The banks, those who have less than that, they may see a dilution, largely because one, their NPS have got adjusted lower. So one, because of that their net worth has come down, and on that lower net worth they need to have a much more higher level of basal net worth. So if you see the difference over here, this is the difference that we are seeing in some of the banks, based on the what they should have as additional coverage that they should have, and what they have as of now. And because of this is pointing out to the dilution that is happening in that should happen because of either government putting in more money, or they coming up with another FPO which would go to boost their balance sheet. And then based on that we have selected four banks for which we have done stress testing for these banks, and on that basis we have selected this five banks, and on that basis these final five banks are been released out as a buy signal for you as of now. uh, we would be moving towards this philosophy as of now, especially whenever economy tends to see a extreme recession scenario, wherein we try to do a stress test analysis of banks to find out what is the worst case possible business scenario that would play out for a bank, and on that basis find out what would be the valuation of the bank. So the the banks that we are trying to release, out of which at least four of the banks that we have released, that is SBI, PNB, and Canara Bank as of now. Bank of Baroda and Indian Bank should be in offering over next 1 or 2 weeks. Uh, should be working on this philosophy. So yes, these have been tested for the restructuring that should happen, NPS that should happen, and the dilution that should happen because of the balance sheet becoming weak as per, and the uh, restoring of the balance sheet that is needed to speak, so to speak of. The follow-up question is by Mr. Naveen Kumar. His question is BHL LNT, which one you prefer? If I hold LNT at current market price, do you want me to move to BHL? Uh, since LNT's 10-year extra itself is open, I would like to point out a very simple thing. Let me on a different um, uh, browser open and a BHL 10-year X-ray also. If you see very clearly, sir, there is a row that I will highlight now. If you see this row, if you see from March 2008, if you see the net operating cash flow row, except for 2 years, L&T has consistently made negative numbers. Now, what does this mean is whenever a company makes negative numbers of cash flow for operations, you would typically see the debt number slowly start going down. Another thing that you need to see is what results in because of that is the ROCE also starts to move downwards. So you are seeing ROC also starts moving downwards at a much more rapid pace than what your EPS should show. So your EPS over here is showing that there is a good decent amount of growth. It has moved from 33 rupees per share to 53 rupees per share. But when you look at ROC numbers, it is going on a negative level. It has moved from 14 levels at 14 to 12 percentage levels to around 8 percentage level. If you are going to be investing into a company that is just earning ROC of 8 percentage, it is much more better to invest into a fixed deposit as of now. If you look on the other hand, if you were to look at BHL as of now, even in this worst case economic scenario, it is still making a decent 22% ROC. I do not foresee its value creation index to be much different from this 1.1 number. It should be somewhere close to 1. This should be updated once the annual report for each of the companies in this sector is available. Uh, and if you look at the cash flow numbers, except for the 1 year, that is 2012, the net operating cash flow for this company has always been very strong. Plus, it has not very significant level of debt to so to speak of. Another thing, if I were to look at is let's look at latest financials. If you were to look at a company that is earning 1,800 crores, we are giving it a valuation of just 33,000 crores as a total enterprise value. On the other hand, a company that is earning a net operating cash flow of minus 3,700 crores, we are giving it a market cap of about 67,000 crores, which looks indecently high for me because if I were to adjust it for the debt that L&T carries, this would be somewhere close to 1 lakh crores for an L&T when it is not making much of a cash flow from operations or its operations. Yeah, so I largely mean if you hold L&T at your current market price, I would rather prefer putting my money into BHL, which would end up giving much more safer returns to me over in the next 4 to 5 years compared to L&T as of now. So that would be how I would play out if it would have been my portfolio. The next question is by Mr. Baswaraj Kalpur. If Fed starts tapering QE, is Indian index can Indian index go to 2009 levels? If Fed starts tapering, it does not have much of fundamental implications to uh, the world economy as such, and I'll tell you why it does not have such. Because while Fed has been printing large amount of cash, there has been no inflation in the economy. Typically whenever central bank starts printing so much amount of cash, you should see a hyperinflation high inflation scenario play out, but a high inflation scenario has not played out. And when you start analyzing why this has not played out, you are seeing that while the Fed is printing large amount of cash, that cash is not going into the main economy or into many of the financial assets as it should have gone out so much. So while on a psychological basis, many people should start fearing a Fed doing a tapering, but you need to understand that Fed tapering just means that he would not buy $85 billion of bonds each year. He would buy a lesser quantity of bonds that can be anything from 85 to $0 billion. I largely think that he would do a much more calibrated way tapering rather than in a single shot decreasing and the rate at which he is purchasing asset. So a tapering means he is still going to purchase asset, but at a much more lower levels. So tapering in its own, I do not think should lead to a 2009 kind of a 2000 and a level of index levels. Would it result in a negative psychological impact on the many of the institutions and many of the investors? Yes, and that opportunity should be used to buying into the index, because this is an opportunity that is coming out, because it makes no fundamental sense, because US Fed tapering means that he is still going to buy some assets. It still means that he is still going to put some money into the economy. And more importantly, you need to focus on US Fed's direction towards interest rate rather than on tapering as such. uh, and because of this reason, I think if a case like 4500 or 4000 were to play out, this would be a largely very short term phenomenon, not lasting more than 2 to 2.5 months, and this period should be used to buy into buy into a strong companies that we are mentioning as of now. Good. ठीक है. uh, ये आपकी है. Yeah. Yeah, I would now be taking last question. The last question is by Ashok Kumar on Kane India. If you look at Kane India, we are given a buy signal at 280. Out of that, it has done well. Uh, I would broadly give this as luck because the market has been much more weaker. So it is largely luck that it has played out well. In the short term, it has given good returns. It is largely, I would give it a luck rather than our ingenuity. Uh, but however, I believe that 280 to 290 price point is an extremely good price point to buy into Kane India, because at this price point you are looking at a company that is rapidly growing its it is trying to rapidly grow its assets. It's rapidly trying to increase its crude production. It will be one of the biggest beneficiary once it starts. Once government of India also comes out with a very good shale gas policy. Because if you were to read a recent news report that had come out, India and Pakistan together are sitting on a very large shale gas asset in that particular region itself. Uh, and Kane India should be one of the prime beneficiaries of that. Our valuation model as of now does not factor that benefit as of now. If it were to occur, when it occurs, it should result in a much more higher MRP than what it is as of now. Our valuation model only assumes that over next 4 to 5 years, the it's a run rate of 1,70,000 barrels per day should increase to somewhere around closer to 2,50,000 barrels per day. Plus, along with that, we are assuming that oil should not see anything below $80 at least for the next 5 years. Over the next 5 years, given that we see that this is a very good case. If I were to get Kane India somewhere close to my DP, I would definitely try and buy Kane India as such. uh, his question is, do we expect to Kane India to go back to 300 again? I think if I were to see Nifty close to 4,500 levels, I think because the broader market would be very weak, it should have a negative impact on Kane India also. One thing that I would like to point out to everyone is certain companies that are not directly identified as beneficiaries of an rupee devaluation also tend to get corrected when rupee collapses. But these are the companies that get benefit out of it. Typically, these are companies like NMDC, Kane India, Hindustan Zinc Limited. These are the companies when rupee devalues, these are the prime beneficiaries. While they do operations in India and at many times they do sell their products in rupee terms, their prices also get adjusted the moment a rupee devalues, because they are internationalized commodities. These are not commodities these which are we do not have an active international market. So even if NMDC sells its iron ore at 4,000 bucks to Indian steel consumers, if the rupee were to devalue to 72, the iron ore pricing of an NMDC would also eventually adjust to that new level of 72 rupees per dollar. So these companies typically do not get identified as beneficiaries of forex compared to the way IT companies get identified as. But I think if rupee were to devalue, these kind of companies would be one of the prime beneficiaries, and we should be look out for them. However, if market were to come down to levels of 4,500 to 4,800 levels, I think Kane India would also adjust to come down by 200-300, because for 20 percentage fall in market, I am saying just 10 to 12 percentage fall in Kane India. So yeah, it should be possible if that should happen. But I would, if that happens, that would be a very good buying opportunity for Kane India at that time. But yeah, I would look out for buying at Kane India only near to DP, not close to EVP, because our operating philosophy remains that we need margin of safety as far as possible. Another thing to please look out for is if US attacks Syria, Kane India again would be a prime beneficiary, because Kane India's production crude pricing is linked directly to international pricing of crude, which if US attacks Syria in the short term would lead to a much more higher pricing for crude, which would also automatically mean that Kane India would also tend to get a much more higher revenue. But please do not be sucked into that kind of rally largely, because that is going to be a much more shorter term phenomenon and not something that is going to last for over next 3 to 4 years. Uh, Thank you very much for being with us. With this, I would like to bring our subscriber webinar to an end. Uh, I hope this was very good for you. Uh, if you have any, please do join us in our next subscriber webinar, which we typically tend to conduct at every fortnight. Do drop us if you have any queries as such. Thank you very much.